Back in October of 2020, I bought an old home in Joshua Tree, California for $227,000. I spent about $45,000 on the down payment and about $25,000 on furniture and renovations to turn it into an Airbnb. And exactly 1 year later, in October of 2021, I sold that property for about $485,000. Now, the month before I decided to sell that property, I knew that my property could sell for about $485,000 thanks to the comps or the comparisons around my property in the same neighborhood. And that means that I had a total equity of about $303,000 in the home because I had $45,000 of down payment and about $258,000 in capital gains. And yes, I do know that I got lucky with that investment. That was a once in a lifetime opportunity, and I don't know if I'll ever get that again in my lifetime. However, that left me in a position where I had a lot of equity within my home. Now that I have this equity, how can I use this home equity to grow my net worth even more? So in this video, I want to share the pros and the cons of the 5 options that I considered using in order to leverage the equity within the home. And if you stick till the end, I'll show you exactly which option I went with. By the way, my name is Michael and I go by Invest Like Mike, and if you're new to the channel, I'm a full-time software engineer and a part-time real estate investor. I show people why they need to be investing in real estate if they want to reach their goals of quitting their job and eventually pursuing their passions. So subscribe if you want to follow along. I make these videos to teach the investment strategies and the concepts that had the biggest contributions to my personal finances. Hopefully, if your situation is anything like mine, you can benefit from the concepts that I teach in these videos and in my other videos. So with that said, let's dive right into the pros and cons of the 5 options to leverage your home's equity. Option number 1, sell the home. Now, if I chose to sell my Joshua Tree property for $485,000, my bank account would have a total of $303,000. I'd be getting back my original $45,000 down payment and then about $258,000 of capital gains. So the pros of this approach are, number 1, I could potentially sell the home for more than what I listed it for. Number 2 is I could have that cash in the bank if I wanted to invest it into something else. But the cons of this approach is, number 1, I'd owe capital gains taxes on that $258,000. That $258,000 would be subject to long-term capital gains since I own the property for just over 1 year. And that means that the following April, I'd have to fork up about 15% of that $258,000, which turns out to be about $38,700 in long-term capital gains tax. So obviously that is the biggest con with this approach of just selling the home and just paying the capital gains tax. And then the second con of selling the home is that I no longer have a income producing property. And then I would say the last minor con is that you have to pay agent commissions and fees when you sell your home. So this property was an investment property, but if this home were a primary home and I had that much equity within the home, you could potentially use something called Section 121 and pay 0 capital gains tax on about $250,000 of appreciation or $500,000 of appreciation as long as you've lived in the property for 2 out of the past 5 years and it's your primary home. If you want to learn more about that, you can go and watch this video right here where I talk more about Section 121. So if you don't want to sell your investment property, option 2 is to do what's called the 1031 exchange. So because this is an investment home, I don't qualify for Section 121. However, investment properties have a different beneficial tax code called Section 1031, aka 1031 exchange. The 1031 exchange would allow me to roll the $303,000 of equity into another like-kinded property without having to pay capital gains tax on that $303,000 until I sold the new replacement property. So again, you're not actually eliminating your tax bill, you're just kicking the can down the road because you're just gonna have to pay those taxes when you sell the new property. So just as a quick example, if I sold the property, I would have $303,000. I could use that and put about 30% down on a $1 million property. Another option I have is I could split that $303,000 into 3 chunks of $100,000. Then I could use the $100,000 to go purchase about 25% of a $400,000 property, and I would be able to buy 3 properties like that. The 1031 exchange is at the centerpiece of my investment strategy, so if you want to learn more about the 1031 exchange, you can go watch that video right here. So let's talk about some of the pros for the 1031 exchange. Number 1, you can defer paying capital gains tax. As long as you use the equity from one investment property and roll it up into the next bigger investment property using the 1031 exchange, you could potentially live the rest of your life without having to pay capital gains tax. So I guess you could say the second pro is that I'd be using tax-free appreciation to go buy more homes. And the third pro is that because you're buying more real estate, you have the potential to bring in more income. So let's talk about some of the cons of the 1031 exchange. Number one, you only have 45 days from the sale of your first property to go identify the new replacement property. And you would think that 45 days is a long time, but trust me, that 45-day period is very stressful. And then the second con is, I guess not really a con, but you have to close on the new replacement property within 180 days from the sale of the first property. And thirdly, if you were to decide to buy those 3 rental properties worth $400,000 each, now you have 3 times more tenants and maybe 3 times more headache. And last but not least, the last con to using the 1031 exchange is that you cannot keep any of that profit in your bank account. All of the proceeds and all of the equity from the first home needs to roll into the next investment property. So that brings us to option number 3, which is a home equity loan. The home equity loan is the simplest option on this list, and it's essentially a personal loan that's given to you on the basis that you have enough equity within your home. So the pros of this approach is that, number one, this loan is a fixed rate loan. And that means that your monthly payment is going to be predictable, which is very valuable in an environment where interest rates are going up like crazy, like we've seen in the past year. And then the second pro to this approach is that it's the first option that we've talked about where you don't have to sell your property. You all of a sudden have access to capital without having to sell your property, which is a great pro. Now, one of the cons of using a home equity loan is that you have a principal payment and an interest payment, and you have to pay that monthly regardless of if you're using the money or not. So as soon as you are approved for that loan and they give you that money, you're automatically paying from day one. So that brings me to option number 4, which is a HELOC, or a home equity line of credit. So think of a HELOC as a credit card, and the spending limit depends on how much equity you have in your property. I would say the only difference between a HELOC and a credit card is that a HELOC actually has like a 10-year draw period and then a repayment period. So during those 10 years, you can use that HELOC just like a credit card, accrue interest or whatever. But then after that 10 years is up, if you have any remaining balance on the HELOC, you have to spend that repayment period paying off that remaining balance. So again, the number one pro with using a HELOC is, again, you don't have to sell your property. And then the second advantage that this has over something like a home equity loan is that if you don't spend anything, you don't have to pay anything. And then one last pro for the HELOC is that it's interest-only payments for that 10-year draw period. Now, one of the biggest cons to using a HELOC is that most of them are variable rate. Variable rate HELOCs can get you into a lot of trouble if you bought something really expensive with that HELOC and then all of a sudden interest rates shot up, just like they did this past year. So if you took a HELOC out on one investment property and you use that HELOC to go put a down payment on another investment property, that can potentially be a very risky move, because if interest rates go up now, that increase in interest rates could potentially make it so that this new investment property does not cash flow, and that could put you in a troubling spot. And a second con to HELOCs nowadays is that there are not that many banks giving out HELOCs on investment properties. You can still very well get a HELOC on a primary home, but the rates are much higher than they were last year. So now let's talk about option number 5, which is called the cash out refinance. And all refinancing means is that you are getting a new loan on the current market value of your home today. So when I bought my investment property in Joshua Tree, I bought it for $227,000. I put about $45,000 down payment, so my mortgage was just about $180,000. So let's call that $180,000 mortgage loan number 1. Now, a year later, my home could be appraised for maybe, let's say, $450,000. Now, if I go to my bank and ask them to refinance, they're gonna give me a loan for about 80% of the current market value of my home. So if they give me an 80% loan on $485,000, that means my new loan would be around $360,000. And that's called this loan number 2. And then what you're gonna do is you're going to use loan 2 to pay off loan number 1. So if I paid off loan number 1 with loan number 2, I'd be left with about $180,000 in cash. Now, obviously, the biggest pro to this approach, and the reason why it's called the cash out refinance, is that I now have $180,000 of tax-free cash in my bank account. And the reason why that $180,000 is tax-free is because loans aren't taxable income. And then the second pro to this approach is that, again, I don't have to sell the rental property. Now, the biggest con to this approach is that because loan number 2 is significantly bigger than loan number 1, my mortgage payment per month just increased from $800 to $1,800 per month. And secondly, the interest rate on loan number 2 is probably going to be slightly higher than interest rate number 1. Or in this case, if I'm refinancing, let's say like 2 years later, maybe it's not 3% anymore. Maybe interest rates are as high as like 5 or 6 or even 7% now. So if I wanted to keep that juicy 3% or even 2% interest rate loan, maybe it's not the best idea to refinance this loan and get a 7% interest rate loan now. So those are the 5 options that I considered when I had about $303,000 of equity in my rental property. So can you guess which option I went with? If you guessed home equity loan, you'd be wrong, because I went with a 1031 exchange. So what I did is that I used the $303,000 of equity and I used it as a down payment for a $960,000 home in the Bay Area. And the crazy part about me 1031ing into this $960,000 property in the Bay Area is that this $960,000 property in the Bay Area is actually gonna save me over $50,000 in taxes in 2022. So what does that mean? That means that I actually bought this home for what? Negative $5,000 and I still own the rental property. And if you don't know the story about how I was able to do that, I actually saved over $100,000 in taxes in 2022. You can go watch the video with my tax strategist right here. We explain the whole thing right here. So one of the main reasons why I use a 1031 exchange instead of some of those other options is because number one, I knew I was going to be reinvesting all of the profits into real estate anyways. Also, I didn't want to choose any of the options where I was left with the rental property still because I wanted to sell it. I wanted to get rid of it. And the main reason why I wanted to get rid of that property is because I was foreseeing that the 2021 travel boom was coming to an end. Now, don't get me wrong. The Airbnb itself did really well on Airbnb. It profited over $20,000 after all expenses that year. And there was a lot of reasons why Josh Tree as a city was a great place to do Airbnb in. Number one, it's the closest national park to Los Angeles. And number two, nobody wants to fly during a global pandemic. So instead, they're going to drive to the nearest vacation spot, which is, you guessed it, Joshua Tree. And number three, Joshua Tree just so happens to be one of the best vacation destinations during a global pandemic because you're literally in the middle of a desert with no one around you. It was the perfect vacation spot to go during these crazy times when everyone was cooped up in their little apartments and they needed some space. But the reason why I didn't want to keep that property is because that home has historically been like under $150,000 for the last 40 years. And then you're telling me that this home went from $227,000 to $500,000 in just under 1 year? If that's not a housing bubble, I don't know what is. And obviously, a lot of that home prices were fueled by the fact that the Airbnb revenue numbers were almost double what they were the year prior. So if you look at the 2021 revenue charts, it would seem like a good deal to still pay twice the price for the home because the revenue numbers were just so good for 2021. So because I wanted to sell the home, I couldn't use the HELOC or the cash out refinance. I wanted to sell out of the market while the market was still doing relatively well and lock in my profits. Then the plan was to roll over that equity into a more resilient market, the market that I understand the most, the Bay Area. And interestingly enough, the home that I sold in Joshua Tree is now worth significantly less today because the revenues across the board in 2022 has dropped. Meanwhile, the home that I bought in the Bay Area has somehow gone up by another $100,000 or so. So I guess you could say that I got lucky again. So now I have roughly $400,000 of equity in just one property in the Bay Area, and I'm trying to decide which of the 5 options I should use to roll over that equity next. So if you made it to the end of the video, thank you guys so much for watching all the way to the end. If you guys want to schedule a one-on-one call with me, the link is in the description below. And if you found this video to be useful, please give it a thumbs up and leave me a comment. I do answer all of the comments down below. So thanks so much for watching, guys, and I'll see you guys in the next one. Peace out.